Jane Street isn't a telegram guru or a flashy signals channel. It's a heavyweight quantitative trading and market making firm, the kind that competes on models, speed, and execution. In simple terms, firms like this quote prices and provide liquidity across markets, taking the other side when someone else urgently wants in or out. Most days, that work stays invisible until a regulator, a headline, and an expiry week collide. In India, it did. In July 2025, India's market regulator, SEBI, issued an interim order alleging that certain trading patterns linked to Jane Street entities may have been manipulative, with a spotlight on index derivatives around options expiry. Expiry is when the clock matters most. The settlement level into the close can decide who wins, who loses, and how big the payout is. When payouts can swing by huge amounts in minutes, every hedge, every burst of volume, and every late day price move suddenly feels like a clue. The core allegation isn't they traded a lot, it's about structure and timing. The concern described in public reporting is that large derivatives positions could be paired with activity in the underlying market in a way that influences the index level into the close, potentially affecting settlement outcomes for options. In fast markets, intent is hard to prove, but patterns leave fingerprints, and regulators follow patterns, especially when the stakes are this high. The case also became famous for the money figure attached to it. Coverage widely reported a disputed amount of about $528 million, described as alleged gains that SEBI sought to restrain or recover while the process plays out. Headlines love the number, but the real story is the mechanism. Expiry day behavior is where market microstructure, liquidity provision, hedging pressure, and price discovery collide. One side calls it sophisticated market making. The other side calls it crossing a line. Jane Street pushed back. Reports say the firm denied wrongdoing and argued the regulator's view was fundamentally mistaken. That matters because an interim order is not a final verdict. It's an opening move in a longer process in which the facts, the trade data, and the legal arguments are subjected to scrutiny. Then came the twist many people miss. Reporting later said certain restrictions were eased after a very large escrow arrangement, effectively parking funds while the dispute is examined. The reported escrow figure was approximately $532 million. Escrow doesn't automatically mean guilt. It can mean hold the money here while both sides argue what actually happened. It's a way to keep the dispute contained while the legal and regulatory wheels turn. And as of the latest reporting, this isn't done. The case remains active under India's regulatory and appellate process, with hearings continuing on the timeline set by the tribunal. So watch the language. Alleged, reported, interim, contested. That's not fence sitting. That's how you stay accurate when the outcome isn't final. Not financial advice, just the facts, the claims, the denials, and one reminder. When billions ride on the close, everyone suddenly cares how the close is made.